Be nice if I had volume, wouldn't it? All right, let's give that a whirl now. I think we're all set. Okay, so welcome, gang. Welcome to Charts and Coffee. Happy Thursday. Good morning. Good morning. Great to see everyone. So we are dealing with the aftermath. Oh, let's go take a peek. For those of you that have been playing along at home, we've got the hot zones that a lot of us are watching: core durable goods, advanced GDP. Look, I'm not really concerned about these numbers, although we know the hot zone is going to affect psychology. But let's get into where it does matter a lot. We're going to take a look at the February expectations for rates: 4.5 to 4.75 column, pretty much 100% expected as we go into next Wednesday. Another quarter point hike in March, taking us from 4.5 and 4.75 to that 4.75 to 5% column, right? Going into May, anything different? We've had this sort of stubborn look at, take a peek here, that 5 to 5.25. That is not going to shock the market per se, because at different periods of the last 6 or 8 months, this particular expectation has been in play. But this would reflect another quarter point hike. This would be, of course, a half point hike, probably very unlikely. The question is, where do we peak? And it's still looking like we peak at 4.75 to 5%. Well, after we get through that peaking conversation, where do we start to see a little bit? Now, it's not a probability, it's a possibility for a cut. Gang, this is November of this year. I know it's on a big possibility, but here it is, the tallest column for the target rate probability come November. This is a quarter point. It's a quarter point cut, depending on where we actually top out. December looks even more dovish in terms of that conversation about when do we start to see a cut. Granted, it's only January. November and December are pretty far away, but this is the way the market is thinking. So we think about, all right, well, if this is what they're thinking, yeah, of course we're going to see equities move higher when the lights at the end of the tunnel, meaning the Federal Reserve is showing us via Fed Fund futures. By the way, people ask me, Rog, do they look at Fed Fund futures? Of course. One of the things that we've noticed through the last few months is that when the Fed Fund futures were creeping down towards about 4.5 to 4.75%, whichever Fed speaker was on the schedule for that week sounded hawkish. They course corrected the broader market participants to, hey, get back to that 5%. We're not going to stop before that. And so, yeah, of course they look at that. And it's been a really interesting two-way communication. As long as we, traders and investors, stay steady around 5%, there's not much for them to have to do or say, because we're in line with what they're planning, at least for now, to do. And so far, the data isn't unraveling that. And then I was on Benzinga this morning, and I said, look, the reason I'm not concerned about a recession, the reason I do not see an economic, not geopolitical, not something coming out of nowhere, a la 2020, but I don't see a macroeconomic reason as a catalyst to more downside. When I'm asked, Rog, why are you bullish? I'll give you a lot of reasons. I'll tell you, we know where the target rate probability is heading. We can already see where cuts could be coming in. We see the dollar weakening. We see bonds moving higher. We see copper moving higher. Heck, even crude has broken the downtrend. These are all rate of change, price-based signs of optimism. So until that is unraveling, what is the catalyst for downside? Something we don't see, That's not trading, right? That's how you get on television, but that's not trading. So that's the way I'm looking at this right now, and I'm not seeing anything. Look, I'm gonna put my money where my mouth is. Our sector secrets mastery folks, we took a long position on the 1 hour chart of the QQQ. We said, hey, there's an opportunity to play some volatility. And that is what we did. And you can see this right on the chart going 9 to 10, 10 to 11 a.m. Yesterday. So we're going to be scaling out of that for sure on the open. So my mastery folks, key up that QQQ call that we bought yesterday. We're going to be offering that out within that clearing. There's no reason not to at least pay ourselves. We are well beyond the T2 that we had talked about. So we're going to scale out again. But those are the kind of trades that are working. 1 hour time frames, not quite day trading, but not longer term trend following on the daily either. How do we take advantage of a time horizon, a window that's maybe 1 to 3 days? This is going to be 2 days in, 2 sessions in. This is the kind of trading that we're transitioning to because that's what 2023 seems to be working for, right? That seems to be where the opportunity is. So as always, let's go ahead and take a look at your questions. And by the way, and I'm trying to find where I have all right, of course, Countdown Trader. If you haven't already checked that out, where's my link for that? And then if you haven't already, yeah, do save the date for February 15. I don't know why this is being so cantankerous, but yeah, do save the date for February 15. We're going to be doing a webinar on the 15th, and I'm going to get into a lot of what we're talking about here right now. So yeah, do save the date, February 15, coming up, coming at you. We're going to talk about the 1 hour chart. We're going to talk about using time and volatility and something that we've been testing, specifically this strategy, for about 6 months now, the overall approach for about 10 months, with an indicator that's been, in my process for over a decade at this point. So really excited for that one. Okay, gang. So let's get to it. All right, jumping over to our free trading room. Let's see here. Tesla. Yeah, I have not been playing Tesla that much. Questions on Tesla popping up. I have not been playing Tesla that much. Again, Tesla's a wild one. It's in a 1 hour uptrend. So buy the dip, play volatility is working. I'm not bearish this market, not in the least. A lot of you know that we stopped being bearish in July of 2022. And going into this year, we talked about January, February being bottom picking season. If we're going to look at those beleaguered corners of the market, individual stocks, sectors, indices, what are those corners of the market that if I am a portfolio manager, if I'm managing money and I've now got an opportunity to start building my 2023 trading plan, my 2023 trading portfolio, am I buying things near highs, or am I thinking about stocks that are in the basement that could start to climb throughout the year? So this is definitely bottom picking season. Don't want to be bearish, especially very, very weak stocks right now. All right. First up here, Heather MBC. Where is the best place to get updated on sector weightings for 2023? I appreciate that. Smash that appreciation. Oh, appreciation button. I like that. That's cool. Chief. All right. The place that I go is the same place I've been going to for years. Let me take you on over there. And that is ETFDB. I don't know these folks. It's got a weird name now, Vetify. But if you head on over here, you don't need a subscription or anything like that. But if you're looking for the sector weightings for, say, the XLK, type that in the search, that little magnifying glass search criteria. Look it up. And then when the holdings, you'll see on the left side here in the menu, holdings, and then there you go. Those are the stocks weighted within the sector. Now, what about sector weightings? Okay, so what sectors are weighted within, say, the SPY? So we went to the stock level. What about a little less granular? Same thing. Pull up the SPY, pull up the SPY, QQQ, DIA, RTY, and then go to holdings analysis chart. Some cool information here from geographic exposure to, like, there we go. There's your holding analysis on the SPY. That's going to map to what's in the S&P futures. So I use ETF DB. I think it's a really cool site. I'm an avid ETF trader. Lots of great information here. Free. That's my preference. This is what we use in the Sector Secrets Mastery, my friend. Yep. All right. Next up, can I please look at Tesla resistance for a covered call? Like I mentioned before, I'm really not interested in Tesla. Resistance for a covered call. I'm not interested in Tesla short, I should say. Um, yeah, my friend, we do have. Well, let's look at what we've got, not what I think. Right? Trade what we see, not what we think. I take a look at the daily time frame. Are we overbought? There's a good argument that we are overbought. Yes. Where? The closer I can get to the volatility levels, maybe 150, the better. Overbought, slow stochastic, my slow stow. What about volume? Do we have anything volume wise that's telling us we're getting a little peaky? Not wowing me on volume. I think my bigger problem is sort of Praveen, it's the bias that I'm carrying that I don't want to be short stocks. So I'm not really interested in, you know, writing calls because that puts me very vulnerable to the continued movement to the upside. That said, yeah, maybe on a 1 hour, if we can find some 1 hour resistance, we can have a very short a very short-term expectation for resistance, but I'm just not liking that. I'll have to pass on that, Praveen. I just want to at least give you the reasons why I personally wouldn't do that. All right, next question. En's asking, what about K Web? Yeah, you talk about corners of the market that have just been absolutely annihilated through 2022, and when that bottom picking season comes in, K Web is ripe for by the dip. And by the dip, that's a mean reversion into the 34 EMA wave. 32 is kind of a nice spot for that. We're above the 200 propulsion. That's straight up by the dip, not by rips, not by new highs, but wait for a pullback, wait for that mean reversion, and then look to build that long position. Can we take a look at Boyle? A lot of interest in natty gas. That's cool. I'm going to start with natural gas. Natural gas is still very much in a downtrend, gang. So let's look at this through the top, sort of the prism of tops. It's still very much in a downtrend. And I know this looks very, very busy. I'm going to just pull up UNG here. That would be the ETF alternative. And ultimately, so let's see. Hey, bot. The DPMRs on NG look cray cray. Yeah, so I was just noticing that. But ultimately, this is a downtrend. So come on, we have two problems, two forces. One, technically, we're in a downtrend. I can't buy. The other force, though, is that we're about 2 weeks away, 3 weeks away from entering the seasonal demand cycle for Natty. So I've got a seasonal bullish corner. I've got a seasonal bullish corner, but then I've got this technical bearish. So until those things align, Kamal, I'm going to pass on really getting too aggressively long-term short UNG. Maybe day trade it. Maybe focus on a 1 hour chart, short term, but not looking at overall movement to the downside as longer term follow through as we go into that seasonal uptrend. All right, next up is, when was the last HPMR updated and how often do they get updated? Sure. So HPMRs are studies that are based upon volatility, historical volatility, Kadar. And when I say we, I mean Lorna and I, we look at the way in which volatility contracts and expands to a certain degree, and then we run new HPMRs. The last HPMR was run January 9th, so it's pretty fresh. Usually HPMRs get updated approximately every 14 to 21 days. So very frequent, so we can have not very frequent, not so frequent that it's twitchy, but frequent enough where we can really uh, account for those compressions and expansions in volatility. So every 14 to 21 days, you'll see HPMRs are updated. On the flip side, the DPMRs, which we'll be talking a lot more about on the 15th of February, those are updated approximately every 4 to 6 weeks. So the longer time horizon, we give a little bit more time to monitor volatility. The shorter time horizon, about 14 to 21 days. And that's the rhythm, the most typical rhythm. Now, if something happens very dramatically, we have a dramatic 2, 3 day expansion in volatility, we'll run the HPMRs to account for that. So we're always monitoring. All right. Next up is Robert. Should I look for plays in the boats of XLY now that Tesla seems to have shifted its momentum? I know Tesla is one of those stocks that, we all watch it for any number of reasons. I don't find it to be that influential over the broader averages. It of course is heavily weighted in the S&P and in the Nasdaq, but there are so many other stocks that are as well. And Tesla's probably more influential, as you said, over the XLY, our consumer discretionary, because of it being the number two weighted stock right after Amazon. Not only has Tesla broken its downtrend, but probably more importantly, Robert, to your point about XLY, so has Amazon. And therefore, if we're looking for relative performance, gang, there's no better way of finding relative performance than what you're looking at right now. Might look busy, but what we're looking at is the structure via the 8, 13, 21, and 34 EMAs, via the grab candles, via the wave, and asking ourselves, what are the strongest stocks within the XLY? Nike, Starbucks, TJ Maxx. After that, I'll look at McDonald's, Lowe's, Target. Neutral markets, bullish momentum. After that, I'll look at Tesla and GM. So you notice we can prioritize, even create a hierarchy of relative performance with this view. Not to mention, we can also look at the price action and its relationship to that all important 200. Yes, you can absolutely look to XLY broadly, but I think there's three other choices easily: Nike, Starbucks, TJ Maxx, all of which are pretty darn affordable paths into XLY. They're lower cost options. They're symbols that we have traded in the past and will continue to look for opportunities in, because the low cost of those options make them small account friendly, make them liquid enough so they're medium, large, and Godzilla sized account friendly, love low cost and liquidity together, very scalable. So those are places that I'm looking at for sure. How do I get the flexible grid? Where it just and this is a layout that I've created for our Sector Secrets Mastery. This is a layout that you can create too if you'd like. I mean, it's just a flexible grid built within TOS, and then I put my tops tools with the trade flags on each chart, and then you'll see the broader average, or the sector, the tide, as I like to call it, is in the upper left-hand corner. The next 11 smaller boxes are the stocks weighted within that broader market, that sector, or that index in order of weighting, which means about every 10 to 14 days, I really have to pop back into the weighting and just make sure that nothing's shuffled up too considerably, because these are not static. The weightings within these indices, the weightings within these ETFs are not static. So we're going to have to monitor them. And this is the way that I do it. So it's just a layout within TOS. It's a flexible grid within TOS. And it's something that we've created for the Sector Secrets Mastery, so we can do this kind of old school, awesome scanning to build our watch lists. So thanks for the question. All right. Next up is Jay Charles asks, why would they cut rates? Is that a thing? What happens if they get to November and not cut the rates and let them be as is? So Jay, I've tried to stop asking in many ways the why question, right? I I try to really just focus on trade what I see. And what I see is the Fed fund futures, which have been historically extremely accurate, more accurate than the talking heads on television, who are prognosticating about crashes and everything else, we want to rely on data, right, Jay? We want to rely on data. And one way of looking at data is the Fed Watch. It's a CME Fed Watch tool that reflects the Fed fund futures. The Federal Reserve does see this. And of course, we could get to November and nothing happens, right? We can get to November, absolutely. But we're not talking about a probability of a cut in November, right? That would mean that this column is up near 80%. That would mean that the column that represents the quarter point cut would be up near 80, right? We're not there yet, but notice that that conversation is happening. We don't have to see a cut. We don't. Because what precedes action? Talk, right? Talk is going to precede action. And that alone, the Federal Reserve, we know this, they can walk a market up, they can walk a market down. Remember, before the Federal Reserve even hiked for the first quarter point, and you remember it wasn't a quarter, but before they even hiked, what did they do? They talked bullishly. What did the equity markets do? They sold off. What did bonds do? They sold off. So even before they took any action, their words, their communication, their messaging move the market around. So that's why we want to monitor the Fed fund futures, because even if they don't reflect what they're going to do, it is going to reflect likely what they're going to say. And we know what they say can move the market. So thanks for the question. All right, Terry, do I think the Fed will cut without significant economic damage? Why else would they cut? They don't have to cut, Terry. So same thing as Jay. They don't have to, right? But one of the reasons that I've been talking about being bullish, right? So when I hear folks talk about being bearish, my question is, well, why? Why would we be bearish? What's the catalyst for, the big sell-off that I keep hearing is supposed to happen? We've been saying since July, not going to happen. Not because I'm trying to predict. I loathe that. My crystal ball has been in the shop for 3 decades at this point. However, if all roads lead back to but recession, gang, if we know something's coming, it's not going to cause a sell-off. Sell-offs are caused by narratives, stories, data that we did not discount into the market. Hence 2020. No one discounted a global pandemic sell-off. If we're talking about it, we're not going to be shocked by it, right? That's my psychological reasoning. But what about my macroeconomic reasoning? It's going to take 6 months. It's going to take 2 quarters to confirm we're in a recession, right? It's going to take another 3 months to confirm if we're still in it or if we're out of it. Likelihood is after the first 2 GDPs, right, 2 quarters, by the time we get to that 3rd quarter, we're usually coming out of it, right? Usually. By the time we get to this R word, the Federal Reserve will have, give or take, 5%, right? This is that bazooka that we talk about from time to time that the Federal Reserve can wield. That means they can start cutting if need be. We know they can. There's a reassurance in that. And so I don't think they need to see economic damage to start cutting. They just need to show that they are in control, that they have the tools they need to deal with whatever may come. That's been the way. There's a lot of psychology behind what the Fed does and the way that we perceive what they can do. There's a lot of psychology, gang, but macroeconomics are going to move growth, inflation, jobs. Macroeconomics are going to move these columns. I hope that makes sense. Thank you for the questions. Good stuff, gang. All right. Next up is Abbott. ABT is in the wave now. Hey there, Kay. All right, let's take a look. ABT pulling back into the wave. Now, why did it pull back into the wave? Why is it? There you go. Earnings. I like to give earnings 24 to 48 hours, so 1 to 2 sessions to sort of settle down before I'll usually trade them. Now, I don't want to trade earnings within a 48. Oh my gosh, it's 9:24. Oh my gosh, where did time go? All right, sorry, gang. I totally ran over. Let me finish my thought here. Give it 24 to 48 hours. The closer we get to that 200, the better, right? But we do want to look at a potential buy. All right, gang. Sorry about that. I don't know where that 24 minutes went. Thanks as always. Great questions, gang. I could have gone on for another hour. Great stuff, gang. Be good to each other. Heads up. Federal Reserve is the first. We know it's going to happen. We're going to get another hike. I'll see you all tomorrow, same time, same station.